Hi everyone, welcome back to our little mini series on Volex, the cable manufacturer out of the UK. Well, really, they're a global company, but they're based in the UK, and they're on the AIM market. And if you want to get access to the AIM market in this particular company, you're going to need a broker that can get you there. Interactive Brokers, link in the description. That's the one that I use. The Volex are definitely on there. Please take the demo account for a bit of a spin first to see whether you like the platform. I've got demo videos here on my channel on how to use it anyway, but yeah, link in the description for that. And let's jump into the valuation today. So the market cap currently sits at around about 400 million, about 500 million enterprise value. Really crude metrics are like a 9, maybe 10 P ratio. I think it's actually closer to about an 8 times P ratio based on the most recent numbers. It's about a 10 times enterprise value to EBIT, and that free cash flow is a bit all over the place with the increasing of inventory, but it's 10 times EV to EBIT is probably a pretty crude metric to look at as whether this is cheap or overvalued. And for a business that I think is really well run, it's diversified and it's a global business and it's on track to double pretty easily within 5 years, I think it's on the cheap side. Now, I think it seems likely because of the quality of this business that we do get some multiple expansion as they continue to perform and grow that earnings per share. So maybe I increase the multiple to say 14x, and on a future earnings per share of 55 pence in 2027, that's 770p, maybe with some stock dilution, let's call it 700 pence, 750 pence, something like that. So the share price at 250, it's a little bit down from that at the moment. I don't know when you're watching this, so it depends. Let's call it 250. That's about a 3x return in 5 years. So assuming that they can continue, just continue, nothing crazy, even can be a bit late on their goals, that's what I think 3x in 5 years. And I know there's a scenario where I am obviously too conservative in this, and there's also a scenario where the competition competes really hard and macro factors interfere. Okay, so on the right-hand side over here, what I have done is I have sort of worked out what I think is an expected return here. So I'm looking at the chances of, like, let's say I'm completely wrong and this whole thing is fraudulent and it goes to zero. What are the chances of that happening? Well, considering it's been around for 100 years, this business, and they have a small dividend, I don't think the cash they're making is a lie, plus all the regulations. I think there's a very low chance that this is a fraud. It should be 1%. Let's even call it 5% to be extra conservative. Then I think there is a chance that things don't play out. Like, it's a pretty low chance. They'd have to fall apart. Competition would really have to mess things up. Macro factors would really have to mess things up, like, dramatically. I'm even countering in some of these higher numbers a little bit of, like, more flatter times anyway. But let's assume 0% growth for 5 years, 0%. And the margins, the free cash flow margin, about 7%. That would be normal margins of about 9, 10%. And the multiple on that free cash flow of an 8, right? Which would be not far off a private business value. And we're looking at a target share price with 3% dilution still as well. We're looking at a 5-year target share price of about £2. And that's down a little bit. So let's even say it goes a lot further than £2. It goes down to 150, 120, something like that. I'm going to say this scenario is about a 5% chance of happening. I think it's very unlikely. I think the more likely scenarios are going to be a 12% growth rate and a 12x multiple. So I think this is pretty likely to happen. I would say that there's probably a few average years and then a few okay years, like okay getting their 20% compounding going, but a few years of not so good. And I think this is probably looking like a lower, maybe bear case scenario, and we're looking at a target price of about 530. So essentially a double from here. I'm saying there's a 30% chance of that happening. And then if I put what I think is more likely to happen, the most likely situation, I think we get a 15 multiple and about 15% growth rate for the next 5 years. It's a great business having a great track record in a lot of areas that can grow with good management. I think this is the more likely scenario. Looking at a share price now of about 760, that's up about 3x from where it is today. I'm going to give that a 40% chance of happening. So I think between the previous example and this example, there's about a 70% chance of those things happening, with some tail risk and some, let's look at the upside potential as well. Let's say they do a little bit better than I expect, and people do finally see that this is a great business, and the multiple goes higher than I thought because the scaled economy shared, they build this big competitive advantage, they become dominant in the marketplace, things like that happen. And we're looking at now a target share price of about $12.50, let's call it. So it's about a 5x from here. I'm going to call that a 10% chance of happening. It's unlikely, but I still have to factor in that is a possibility on the spectrum. So now let me go through my thesis. And I think part of the thesis is that there is a lot of sweat and tough times that Nat, the CEO, and John, the CFO, have put in to turn this around. And they must have developed a strong emotional attachment to this business, which I think can crystallize their resolve to solve future problems. And I think it also will make them want this to be really huge and a really big success. That's just personal. That's how I sort of feel it from the guys talking about their business. And that seems pretty logical to me as well. Can you imagine getting this business 10 years ago and it being in dire straits, deciding whether you should close it up or a 100-year-old business, or do some dramatic things and let a lot of people go, change things essentially upside down, and you're finally getting the rewards for that? Why would you want to blow that thing up? Why wouldn't you not? You would be thinking that the good times are just getting going. Like, it would be really exciting for them. So I think there's a lot of sweat equity in this one. So I like that management have shown this incredible guts, dedication, and skill. And in a growing market, that they have now developed one of the strongest brands. And I think all of that impresses me the most. I think there's a really long runway for the sections that they're in to grow. Adding aerospace and defense as a more recent acquisition as well gives them potentially an entirely new stream. I think they're using this scaled economy shared idea to always be expanding and deepening their moat. They're diversified across countries, across products, across customers. I like this diversification. They've got strong return on invested capital metrics for both internal investments and acquisitions. They're focused on disciplined returns, and there's plenty of places for them to reinvest. They've got high insider ownership and that sweat equity like I was talking about before. And the debt levels are really manageable. Now, on the other side of this, these are the things that I don't like. I don't like that it is capital intensive. This is still a manufacturer, and this will always be a drag on the business. It will never demand a high multiple because of this. It doesn't make it a bad business per se, but they have overheads that just cost money to run and maintain. Although I like the competitive advantages that they have, the products could be found somewhere else if necessary. We have to be honest about it. They're making cables, and it's not that painful to switch. The brand is great, and if you're a Tesla, you want the best quality ones, but you could probably work with the manufacturer to get a similar quality product up and running in 6 months, 12 months if you had to. So if Volex and Tesla had a falling out, or Volex and some of their other big clients had fallings out, I don't think it's that big of a deal for the Teslas of the world, rather than it's more of a problem for Volex. And lastly, I don't like that stock-based compensation. I want to see that really minimal going forward. If it stays below 3%, I'll be okay with that. But I like the idea that they're trying to incentivize the people that they work with to be part of the business and part of the success. But stock-based comp, I don't know, it doesn't sit that well with me. 3% seems pretty high, but I'm okay with it as long as it doesn't get out of control. Now, why does this opportunity exist in the first place? Well, I think because simply it's a manufacturing business and it's not very interesting. Plus, it's a small cap UK company. It takes quite a bit of digging before you can see what's special about this one. It wouldn't screen very well, and most would pass on it after, say, 5 minutes, like me included. All right, so questions, criticisms, please hit me up with them. I need to figure out why I shouldn't invest in this. I need someone to pull this apart for me. So if you could do that, I'd be very appreciative. You can leave it in the comments below. You can join my Discord group for that. Remember, if you want to invest in this one, you'll need interactive brokers. The link's in the description for that as well. All right. Criticize me as much as you can. I'm wanting it. Otherwise, I will see you in the next video, and I hope you're enjoying these little mini series that I'm putting together in May.